Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites JugglingDynamite.com and VenablePark.com. Welcome back to the show.
Thanks, Jim.
Well, we know about the losses that cryptocurrency has had and the stock markets, but what about the private holdings people have? Do we know how bad the damage has been yet?
No, we do not. So this is this opaque part of the market which has really risen to great popularity in the last decade as central banks suppressed interest rates and kept the easy money policies going. People were really forced out of low yield products because they wanted to make more on their savings, and so they gave larger and larger portions of their money to really illiquid, higher risk securities, funds, managers, that sort of thing. So this is both on an individual level as well as on a pensions. Public pensions have basically, over the last number of years, allocated up to 25% of their capital towards these, what we call private equity pools. And the managers of them were putting things into increasingly illiquid, sketchy parts of the market on the idea that, this was long-term money. Very often it's locked in for a certain period where you're not allowed to request redemptions instantly. It's not mark-to-market daily. I've talked to a lot of private equity people in the last few years who were doing things that just basically blew my hair back in terms of the amount of risk, but it was all sort of hidden inside these, as I say, funds that didn't have to mark-to-market. And they could, as long as asset prices were going up, they were borrowing money to magnify returns. They were very much operating a lot in the real estate sector, commercial loans, all sorts of high risk debt, borrowing, lending, credit, in all sorts of fringy areas of the market. And people thought this was great for a while, but the irony of it is as more, and this is very typical of strategies, as more capital gets attracted to them, they basically run out of really good places to put money. This also happens as cycle prices go higher. There's less compelling investment opportunities for everyone, and so people not wanting to sit in cash, God forbid, because that's always considered to be, not looking busy enough or not looking like you're a genius enough, right? If you have to deploy capital as soon as you're given in most of these funds because they have a mandate to be fully invested at all times or to get money invested within a very short period of time. So all that really happened, and as I say, as long as prices are going up, it looked like they were doing well, although in reality, even to the end of March, the returns of these funds matched the S&P 500 with less liquidity. So that, on a sharper risk-adjusted basis, means that they were underperforming, right? So they're giving you more risk than just holding the index itself, higher fees, and less liquidity. So really not an attractive bet at all from the investor's perspective, and yet they've been very popular. So that happened, and now what's the case is we've had, as you know, 3 quarters of plunging market so far in 2022. It's been the worst start to any market cycle in many decades. Even the sort of so-called conservative sectors like the Dow 30 index is off 20%, the transports are off 30%, the S&P is off 23%. The Canada's TSX is one of the best performers, and it's off about 18%. This is just, from highs in March and that sort of thing. So the pace of this decline has been really rapid and widespread. Bonds have also sold off, as we've talked about before. They've had the worst year since the 1970s. Now, there's a great deal of difference, though, between different credits and different credit qualities and the likelihood of being repaid your principal. And in the early stages of this market decline, that wasn't really taken into account. We've seen actually the junkier debt in some cases has declined less than the higher quality, government issues. And that's really a function, I think, of this, as I say, so many people buying into that space, looking for yield in the last few years, that they've been basically, when margin calls come, which is what happens to people as they're levered long on things and the prices start to fall, they have to start selling their holdings to pay down or raise cash as redemption requests come in. And ultimately people start, it's quite typical for them to want to sell the most liquid things or the things that haven't gone down much to try and keep the dream alive, to hold on to these things that are plunging. So I think that's why we've seen higher selling pressure in some of the higher quality credits and not so much in the lower quality. So what happens, and I've been through a few cycles now, Jim, what happens is that as this deterioration in other assets continues, this is a good old-fashioned bear market this time, right? This is no, March 20 V-shaped jump bound back up again. This is a good old-fashioned bear market. So this is going to be with us for probably several more months, if not more quarters. And what happens over time is that people get worn down. Ultimately, they've already sold off whatever liquidity they could, and they start then selling these less liquid assets. And that's things like preferred shares, but it's also things like REITs and, as I say, all these esoteric, bizarre credit pools and things that have been put together by these fringe groups over the past decade. And once that selling happens, the problem is they are much less liquid, much less broad, and you can see really sudden drops in price as people, are forced to basically cash out. And so the other little nugget there is that these instruments, as I say, are not marked to market, these funds, so they report at a lag. So, for example, the pension funds are all negative year to date because the average portfolio, which is this typical 60%, equities, 40% fixed income basket, is already off 20% year to date, which is the worst year for that kind of a balanced portfolio in many years. And if people have more equity in their accounts, which most people did coming into this downturn, they'd all left the bonds and things for these more esoteric things. So ultimately the average portfolio is off more than 20%, more than that sort of typical 60-40 mix. But it's even worse than that, Jim, because most of these private equity funds have not actually reported their year-to-date losses. And this is a function of this, how they don't have to mark to market daily, but they do this sort of a retrospective reporting. And so the pension figures, which are, the public pensions reporting negative returns to the end of June, but they haven't actually factored in their losses on the 25% of the portfolio, which is this private equity stuff. And they don't have to actually report that, and they won't until the end of the year. So at that point, I think that the loss numbers are going to be much higher for a lot of portfolios than people presently perceive. I know for a fact, because I was, again, speaking to people in that sector in March of 20, many of them were breathing a sigh of relief by June of 20 because, as much as abrupt as prices had fallen, they had already started to recover sharply. And so they were all saying, thank goodness we don't have to mark to market, and thank goodness we don't have to give people capital back right away. We have typically, a 3-month window where they have to request before we actually come up with the cash. So there was all kinds of reasons they were they were saved at the bell, so to speak, in the 2020 collapse because it was so short and sharp and then bounced back. But of course now, today, we have the exact opposite financial conditions in the world where central banks are not racing to the rescue, but indeed committed to the most aggressive hiking cycle since the 1980s. So there's no Fed put coming in the near term here, and I think that the liquidity problems, which are getting really sharp in the world, are going to compel more selling of these assets, which really haven't been market tested in ever, and certainly not in the kind of conditions that we have now. So I think that the news that's going to come out as the year unfolds, as these reported prices actually fold into portfolios is going to be another negative for people and for investor sentiment.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park, continuing with this theme. Didn't central banks encourage reckless spending and borrowing, and now it seems they're hell-bent on punishing everybody who borrowed money for whatever reason they borrowed it?
Absolutely.
Yeah.
So I've had a lot of conversations with people or seen people writing, speaking with frustration and anger directed at central banks right now for raising interest rates. And I understand why, because there's a lot of pain going through all sorts of sectors. Every major sector in the stock indices are all negative year to date. Housing is in a free fall. A lot of people are coming up against renewals or floating rate variable mortgages. 60% of Canadian mortgages taken out in the last year were variable. That means like a third of Canadians are now facing higher mortgage rates, much higher, 3 times higher over the past few months. In terms of interest expense than they had before. So there's a lot of pain to go around here. The problem, however, is not about raising rates. The problem is actually the, pernicious policies of the last decade where they were recklessly inducing gambling and debt creation by keeping rates so low, by pumping liquidity, by incessant quantitative easing, as they called it, even as the economy was, so-called doing, even in the periods where the economy was doing well and financial markets were at all-time highs, they continued to pump liquidity, which was excessive and caused all these asset bubbles and engendered very destructive behaviors and really did make people addicted to a gambling mentality. We saw that both in the choices they were making and people, borrowing against their house to buy all manner of madness like cryptocurrencies, or some people took out loans to buy, virtual real estate in the Metasphere, Jim. I mean, it was really just a gong show of horrendous choices. And the central banks very much aided and abetted that. Absolutely. There's no question that none of that or the extremes of what happened could not have been sustained if it hadn't have been for all the free and liquid funds that were tossed into financial markets in the banking system during this period. Policy decisions were also poor. One of the few things that the Canadian policymakers got right was actually to stress test mortgages, and there was a lot of criticism around that, but thank goodness they did, or people would be even in worse shape today than they already are. Just having to qualify for that notionally higher interest rate than was market back, a couple of years ago has left a little bit more room than would have been available if people had not had the stress test in the system. Now, of course, there's a lot of cry to take away the stress test. They've done that already in places like the UK because this housing downturn is global, right? It's not just Canada. It's unfortunately that Canada came into it with the highest household debt and the highest valuations and the most, crazy of many of our peers, along with places like Australia and New Zealand. The housing market in the U.S. is already, looking frothy and deflating, similar to what it did after the 2006 peak. But Canada, of course, is even that much worse. So, to make a long story short, there's been a lot of blame to go around here. Policymakers definitely are at the forefront of throwing gas on fire that was already burning too much. However, individuals also made horrendous choices. Now, I like to say that there is a public duty, there is a greater good component where there's supposed to be some wise leadership from the top because most people don't know anything about money. Most people certainly don't know anything about investing. And we live in a culture where, they're bombarded with these ideas that it's easy to do or that, it's all about, quick decisions, and when prices are going up, it looks like people are geniuses. What they're finding out now, of course, is that it wasn't actually investment genius. It was just low interest rates. And now that interest rates are higher, it's, the whole risk premia is being repriced. And, it's just going to be a lasting, lesson, I think, which is, in some ways a good thing, because unfortunately we humans tend to learn from pain much more than we learn from easy conditions.
Canada. The U.S. has a term for it, snow washing, money laundering in Canada. Just how bad is it here, and what are our governments doing about it?
Yeah, so this is, there's been so many studies that have looked at this. There's been Sam Cooper's book, Willful Blindness, which I've spoke of before, really lays it all out in detail about the influx of illicit funds, the drug trade, money laundering that has flowed into Canada through our banking system, through lawyers' offices where they don't have a duty to to investigate or confirm the source of funds, which is a loophole to all the FinTrack stuff that goes on. So we've had this steady flow of money coming in, and it has helped to inflate our property prices. Part of what I explained in terms of why Canada's housing is so horrendously overvalued, and now why it's so painful and why we're going to have such a prolonged downturn in that sector, is because of this ballooning effect that went on in the years prior. So the U.S. State Department has already labeled Canada as a major money laundering country. They do call it snow washing as a joke because we're supposedly in snow all the time in Canada, I guess. But it has, so this is just another study that has pointed out that it's just so obvious, so glaring. Again, so long as prices are going up, people have, it seems like, a blind spot or a abhorrence to looking at the truth. And then once all hell breaks loose and people are losing money, as now is happening, prices are falling, and you've got this really awful knock-on effect of one sector leading to another, and of course our economic growth was so heavily skewed towards the housing sector in the past few years that now this hit to our GDP is going to be even bigger in this downturn. And we really haven't seen a housing downturn in Canada since the 80s and 90s. So there's a whole generation of people today that have no clue, were just like lambs to the slaughter, didn't understand what was going on and didn't realize that housing isn't a good investment at any price, and they are now, going to pay the price for that naivete. But the point I'm trying to make is that now surely I always thought that once the price bubble broke, perhaps we would finally get the interest or the will or the initiative to crack down on these illicit funds, which have cost us all so greatly. Because if you look at the balloon in household finance and the debt side, that was directly related to people overpaying for houses. Most of the debt in Canada, we have $182 dollars of debt for every dollar of income in Canada. Again, world leading in terms of debt bubbles. And the bulk of that came from people stretching to buy housing. So that is, as prices come down, as the debt has to be either written off, written down, paid back, it's going to take years. But surely now we might reconsider stopping up some of these holes and forcing more transparency and reporting to trying to deter these illicit flows into our economy.
Danielle, thank you so much for chatting with us.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.